of the biggest market stories from the past week. Join host Anna Sarin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Welcome to the market recap, the weekly market recap. I'm James Black, filling in for Anna Sarin this week, and I'm joined by, Bruce is back up, but actually I see as 1A to 1B, it's Jordan Youl from StoneCastle Investment Management, which is in Kelowna. I should mention that you guys are located out in Western Canada. I'm out here in, let's call it Toronto. And a lot to talk about in the market this week. First of all, Jordan, how are you this fine day?
Yeah, I'm doing great. Thanks for having me. It's always good to chat with you.
Yeah, absolutely. So we're going to look at a lot of economic indicators on this week's episode, as we often do. We're going to, touch on recession fears. We're going to talk about sentiment. And first of all, we're going to start with what's happening with the S&P 500. So maybe give the fine people watching today, what has happened with the S&P over the last week, and what indicators are we seeing there?
Yeah, no, absolutely. So, when I was on the show a couple of weeks ago, I just talked about the opportunity set with the massive rotation that's taken place internally within the markets. What had been a concern up until just a couple of weeks ago was really poor market breadth. So the number of stocks really participating as the S&P 500 is challenging, previous highs. So we've had some follow through this week, and the S&P 500 is hitting a new 52-week high, which is fantastic. But more importantly, beneath the surface, the advanced decline ratio in the upper panel of this chart is actually at an all-time high. So when we're scanning for ideas, screening for opportunities, breakouts, momentum, we're just seeing a lot more participation across the spectrum. And this is not just in the large cap space. We're actually seeing improvement in the small caps and mid caps as well. So that's really encouraging, especially as the market is just, several, percentage points from, hitting all-time highs.
Wow. And to think that things were, with rising interest rates, not doing so well. So how did we get here? You mentioned tech and industrials and discretionary lending, some of these things, but maybe with tech, I know we've talked about NVIDIA quite a bit, and there's other big tech companies that obviously move the market, but anything in that particular sector that is worth looking at closely?
Yeah, there's different industry groups within the technology sector. So when we're analyzing the different industry groups, there's several that represent the technology sector. There's software and hardware. The semiconductors have been quite resilient as well. But more importantly, if you take a look at the equal weight version of technology relative to the market cap weighted version like XLK, that's improving. So that's just telling us within the technology sector, we're just seeing more industry groups and issuers participating. It's not just, the 3 or 4 stocks that really drive the market cap version of the TS or the technology sector.
Yeah, of course. And so if you're looking into your crystal ball or trying to make projections, judging the fate of, say, Facebook or NVIDIA or one of these larger tech companies, might not necessarily be the indicator where the tech industry is going. I know with all the things that are happening in the AI space and other sectors like augmented reality, we saw Apple's new headset. There could be a new breed of companies that are coming to serve these particular subsectors of the technology industry. And I think that's what's really exciting to me, is that if you're prospecting, you're trying to look for the next big winner. It may not be the big guy necessarily. It could be one of these smaller weighted companies, as you say, that make up the S&P, or maybe someone who's not even on the S&P today, that could be one of the future leaders of the technology industry. So we know by just looking at history, nothing's ever settled, and you can never take today and project into tomorrow based on who's dominant in today's terms, because things happen just far too fast.
Yeah, absolutely. Okay. Yeah.
All right. So let's talk about sentiment, because this is another thing I know you're a very interesting chart. When you talk about fear and greed, that gets my antennas up.
Yeah, the CNN Fear and Greed Index is a good bellwether, a proxy that we like to track, just because there's so many factors and variables that go into it. And, if you go back 1 year ago, there was extreme fear in the markets. We're in a bear market. Any type of rally, there was very little follow through. But, today the sentiment has shifted and changed. And, now we're at the extreme greed side of this particular index. And, as the market continues to break out, investors are a little bit more comfortable putting their capital to work and looking for opportunities. And we've seen, the cash on the sidelines that were really excessive, and especially in October of last year, is starting to be put back to work. And we're seeing that on the retail side, but also on the institutional level as well.
Right. And so two questions. One, just describe what the VIX is, or VIX. What's that stand for?
Yeah, so the VIX is the implied volatility of the S&P 500. So it's inversely related to the S&P 500. So the fact that the VIX is at a 3-year low, it's at levels last seen during COVID. That is just telling you that, there's some complacency in the market, and that kind of aligns with the CNN Fear and Greed Index. But it's just telling us that, the day-to-day intraday volatility of the S&P 500 is not substantial right now. So having said that, I wouldn't be surprised to see maybe a little bit of a pullback in the market, which is totally normal and healthy, because we've had a pretty strong several weeks here in the market. So yeah, the VIX is low, so there's not a lot of fear in the market right now.
Okay, so now this is making me think all sorts of things. Are people trying to anticipate that rates are, especially at the Fed level, going to ease off, and getting ahead of, a dropping interest rate, perhaps by playing in the market? Or is it something else? Is it perhaps that everyone's weighted so heavily into interest-bearing securities that, there's only so much yield you can take before you got to start diversifying back into equities?
Mm-hmm. Yeah. So if you go back earlier midweek, when the Fed paused, that was expected, going into the FOMC meeting this week. The market was anticipating that the Fed was going to pause. So that wasn't a surprise. But the market is anticipating 2 additional hikes this year. There is a high probability that the Fed could go 25 basis points for their upcoming meeting. But effectively, there's going to be, data dependent, right? They're just going to, take it as it comes. But, we're not out of the woods yet, but I think we're definitely late stages of this rate hike cycle.
Okay, so some degree market timing, but also just, there's things at good prices likely in the market, and that's when the smart money tends to go in. Mm-hmm. Okay, let's talk about now, with all the positivity that we've mentioned, recession fears. So we've talked about, the S&P being at a 52-week high, but how does that relate to the fact that people still think we're on the brink of recession?
Yeah, and I think that's why it's been so challenging, the last 12 months or so, is because, everyone's been calling for this recession. If you look at the US LEI index, which comes out next Thursday, it's been declining for 13 consecutive months. Yield curve inversion, there's some economic factors that investors tend to lean on that are mixed. However, the market is, breaking out and hitting new, 1-year highs, and breadth is broadening out, and et cetera, and so on and so forth. So, what I did was I put a poll on recently, which expires. This is a live poll here.
It's on Twitter, Jordan, or where's this poll?
This is on LinkedIn.
Okay.
LinkedIn, and I have another one on Twitter. But it's really just to try and get a sense of, where investors are at. Is a recession imminent? And 54% of the respondents, as of today, believe that we are already in a recession, right? And so, which is quite interesting. When I'm speaking to a lot of investors and advisors, they don't want to miss out on the run up in the market, but they have, in the back of their mind, they think a recession is just right around the corner and whatnot. And like I said, the response, 54% are saying that that we already are in a recession. But what's really fascinating is, just to remove the emotions and just look at, the objective data. In the backdrop, I've overlaid 2 charts, economic factors that the NBER considers most important to determine whether or not a recession is just around the corner, or if the U.S. recession is actually in a recession. So one is the total non-farm payroll. The other one is the real personal income. And what's really interesting, as shown in the chart here, both of these economic factors are at all-time highs right now. So there's a little bit of a disconnect. So the takeaway here is that, a recession could occur, but we just don't think a recession is as close as maybe some investors think. And, this is something that we just got to monitor and watch very closely. So if history is any indication, we would see the data from these two economic factors start to slow down and turn negative and break down. And at that point, we'd be like, okay, maybe we're closer to, going into a recession. But if you just look at the data, that doesn't seem to be the case right now.
Yeah, no, I hear you. And no, good on you for putting that poll up on LinkedIn. Okay, well, yeah, I mean, it is been debated on this program, or at least, we've echoed that some people are arguing for a recession, or projecting a soft landing type scenario. But, in your mind, and this is maybe a dumb question, but can the economy continue to be in a recession, but the S&P and the stock market continue to go up?
Yeah,
In the short term, I suppose.
Yeah, the stock market is not the economy, right?
No.
They are different. But the way I look at it is just separating it into three categories. So phase one would be, the rate hike cycle, which we're currently in. And then when the Fed pauses for an extended period of time, the market tends to melt up and perform very well. Because from a sentiment perspective, investors like, okay, the Fed is no longer hiking. And then we tend to see, equity markets, risk assets start to perform. I believe we're kind of there right now. And then the third and final phase is when the Fed cuts with deteriorating economic data. And then that's when the markets and the economy head into recession. So we just have to take it step by step. So I think we're starting to transition from like phase one to phase two. And in phase two, we could be at, these levels from a rate perspective for an extended period of time. It could be multiple quarters, it could be multiple years, right? So, based on the evidence of the markets, the leadership, so the early bull market sectors that tend to lead, bull markets like technology, communication services, industrials, and consumer discretionary, they're, really strong right now on an absolute basis and on a relative basis. And the leaders in the defensive proxies from 2022, like U.S. healthcare, consumer staples, utilities, and even energy, they've been lagging and underperforming, right? So we've seen a pretty massive rotation from a leadership perspective. And that really kind of coincides with history. When we're in a bear market, those defensive lower beta proxies tend to do really well. And then when we come out of that, off the October low, we start to see money flowing back into the cyclical offensive higher beta names. And that's what we've been seeing year to date. And that's what's been driving the market. So, as we attempt to, make new highs at the index level, we really have the right industry groups, sectors leading. And that's very constructive and positive as capitalists and as investors. I'd be more concerned if we were being led by utilities and telcos right now. So what we're seeing, being objective, relative strength, trend, makeup of the leadership is very constructive and positive. So yeah, we're excited, and at the portfolio level, we've been putting cash to work. So
good. I like that pragmatic approach. Not negative, but realistic, and obviously somewhat cautious. Okay. CSE news. So I'm just going to bring up a press release that came out earlier this week. So often we talk about our clients here on the show. It's our own program. And this week we actually had some great news to share, which is securities listed on the CSE are now eligible for margin relief. And so we won't get too much in the technicalities, what that's all about, other to say then it would now allows investors in certain securities, dealer permitted, to basically borrow cash from their investment dealer, from their broker, to buy securities or sell securities and transact. And so what that really does is allows people to use leverage. And what we talked about before the show, Jordan, was just who might some of the people be that this is impacting? Because I feel like for most people watching the show, they may not know or appreciate that this margin thing has been off the table for our companies for up to the start of our history. 19 years we've been trying to get this. And now it kind of introduces a new group of players, perhaps, to play with these stocks. And maybe just outline who you think this is a feature that's going to really benefit.
Yeah, for sure. Just starting from a top-down perspective, institutional hedge fund managers just trying to generate some alpha, especially if we're rotating from a risk-off environment to more of a risk-on market environment, just to try and generate excess returns through leverage. So it definitely attracts the retail investor, the day trader as well, swing traders. But like you mentioned, it's going to attract a new group of investors to this market as well. So yeah, it's definitely exciting for sure.
Yeah, and based on the phone calls and emails I've received on it, it's been widely well received, and definitely from people who I didn't even expect would be interested in this. So I can't say who, but it's been a really great development for us, and hopefully something that benefits the end investors, but also obviously the issuers who are obviously on the CSE to have the most streamlined and low cost of capital access to funds. So that will be yet to be seen how it all works out, but very positive for us. All right. So what are we thinking about next week? I know you've got a few thoughts looking at the calendar for next week.
Yeah, for sure. The U.S. markets are closed on Monday for Juneteenth, but the big, economic data point that I'm going to be looking at is the U.S. LEI index, which comes out on Thursday. And as I mentioned at the top of the call, it's been negative for 13 months in a row. So I'd really like to see, the rate of change, start to turn up again, because again, that's a weight of the evidence index that has a variety of different factors. So definitely an important piece of information that's in our toolkit for our investment process. So that's coming out on Thursday. But just at the market level, I just want to see some continued follow through. We're starting to see, more breakouts. Like I said, more stocks are trading above their 50-day, 200-day moving average. So yeah, I just want to see some follow through. The high beta versus low volatility ratio is about to make a new swing high, a new breakout. So that would be significant. And I think that's just providing confirmation that investors are putting more capital into these higher beta, torquier, growthier type companies, which we really haven't seen, since Q1 of 2021. So I would just like to see everything I've been kind of building on over the last 2 to 3 weeks continue going into next week.
I like that term, growthier companies. I think we've invented a new word on the show.
Yeah,
all
that's
right.
a word. Yeah.
All right. Well, once again, I'm James Black, and that was Jordan Youl. And thanks again for your time. If you're watching this on LinkedIn, give us a little thumbs up. If you're on YouTube, consider just subscribing. Why not have this show up on your feed every week? Why not? Or if you're on Facebook, or even watching this on Twitter, please give us a like, a star, whatever it is there that shows that you appreciate this content. I appreciate you being on the show this week, Jordan. Until next week, maybe we'll see Anna and Bruce. Keep watching, and thanks so much.
Yeah, thanks for having me.
All right, take care.